Hi guys, it's Josh here. This is the first episode of my public portfolio. The recording that I'm showing you now is the recording that I made on the 1st of August 2019, which basically shows myself placing the orders for the portfolio on Inception date, and that's done on the Sharesies platform. The amount that I started with was $1,035. Of that amount, 1,000 is from my own deposit. The other 35 is money that I've received from people who used my affiliate link to join Sharesies, and that's before the offer expired. Thanks for supporting the channel. Going forward, I will add in the equivalent of $5 a day, or about $100.50 a month to this portfolio. On top of that, for every 100 subscribers on this channel, I will add in another 100. So make sure you subscribe to this channel to see the portfolio grow. I will show you my rationale of how I invest this $1,035 later in the video. The stocks that I buy on here are not stock recommendations. You should always do your own research before investing. The stocks that I have in here are stocks that I know well and I am comfortable holding them. Now, just to talk a little bit about the Sharesies platform, there is one thing you need to be aware of. As you can see in the video, when I place an order for either an ETF or individual stocks, the price that I am paying is the market price. The price shown for the stock that I'm buying might not be the price I am getting. This has to do with the buy-sell spread. So in this example here, I'm buying Somerset Group. And as you can see, the order is $124.20 and the share price is $5.62 per share as at an hour ago. So that's not necessarily the price that you're getting when you execute the order. The buy-sell spread is basically the difference between the buy price and the sell price. When you buy on Sharesies, you will only get the best sell price, and that might be different from the current price. And it's most likely going to be different from the price as at an hour ago. You don't have to worry too much about this when buying funds, as the buy-sell is usually pretty narrow. But when it comes to buying individual stocks, then the spread can get quite wide as there isn't as much depth. So I've emailed Sharesies asking for a limit order function to be implemented on their platform. And they responded saying that this function is on the top of their priority list. So hopefully, I'm hoping that they release this function, as it can be quite annoying when you end up paying a higher price for shares. Later on, I will show you the spreadsheet that I've made, which shows the thresholds that I have bought for each asset that I hold in this portfolio. Alright, welcome back. So here I have produced an Excel spreadsheet which details the holdings of the fund. Now, before I go into the detail, I just want to make a few things clear. Equity markets are currently at its all-time highs. I would not be surprised if 1 year later the market is at a lower level than today. So with that in mind, there are two things that I would do. One is I would dollar cost average in, keeping in mind we're not trying to time the market, so that's why we're buying in slowly. And secondly, I would hold a good level of cash. Alright, back on the topic. When I made this fund, I wanted it to be a well-diversified portfolio that pays a nice dividend and have moderate growth as well. In New Zealand, dividend investing is the most tax-efficient way to invest because you don't get taxed on your capital gains if you buy shares for their dividends, right? So this is not tax advice. If you need tax advice, consult an expert. Knowing the tax implications, I try to look for companies that can grow their dividends over the long term. Another thing to have is diversification across different countries, which is why, as you can see, half of the portfolio emerging markets fund, US 500 and Aussie mid cap. That makes up half the portfolio. And the reason being is that if you're earning your income in New Zealand dollars, and if the New Zealand dollar weakens, your money is worth relatively less compared to other countries. So the US 500 is denominated in USD, Aussie mid-cap will be in Aussie Ds, emerging markets, that would be in the local currency, but the fund is held in US dollars, but the assets within the fund are held in whatever country they're in. So for example, if it has Tencent, then it'll be in Chinese yuan. Basically, it's the underlying asset is in China or Brazil, whatever assets that they hold, but the majority is from China. So I have a good mix of all of those three economies and currencies. Also, when I formed this portfolio, I framed 3 rules that underpins the investment thesis for this portfolio. And it's just basically to reiterate what I said before. The first thing is pays a satisfactory dividend yield. So if you can see here, all of them pay a dividend, and the average is 4.21%. So it's quite a good dividend yield, more than your term deposit in the bank, which currently pays about 3 to 3.5%. The second ground rule is companies within there might be able to grow their dividends in the long term, so whether they have a track record. So if I can see here, these are all individual companies and the ones above are funds. So of these individual companies, they are all quite high yielding. So they average about 5.65%, which is more than the fund average because it gets dragged down by this US 500 fund, because US firms, they don't really pay out dividends. That's not tax efficient in their country. New Zealand shares pay good dividends, but you'll notice that these two, Somerset Holdings and Main Freight Holdings, I'll go into a bit more detail later, but they pay less dividends because they are high growth companies. They reinvest more of their earnings, but we expect the dividends to grow as earnings continue to grow. So that fits strategy number 2. The third one is to diversify into foreign funds, and I said between 40 to 60% of the portfolio. So we're at the midpoint of that. We're at 50%. So those are the 3 rules. Pays a satisfactory dividend, can grow the dividend in the long term, and to have diversified into foreign funds. Now, the individual stocks that I briefly mentioned here are basically stocks that I know better than the others, because you should always do your own research before investing. Disclosure, I own the top 3 in my private portfolio. Just thought you guys might know that in case you think there's any bias with these stocks, but they are the top holdings because they're high conviction plays. So let's go into a bit more detail. So the first individual stock that I have is Somerset Holdings at about 12% of my portfolio. As you can see here, they operate in the retirement and aged care industry. Aged care industry is a industry that is going to enjoy a lot of tailwinds from the aging population. That means that in the long term, as baby boomers grow old, then you expect demand for these retirement villages and aged care services to go up. I see this as a really long-term play. At this current price level, I see good value because their underlying earnings is close to about 100 million, and so you're paying about 13 times trailing PE. A very good value, and they've grown their underlying profit by quite a high growth rate, about 40% for the past 6 years, if I recall. 40% per year for the past 6 years, right? So I do see them being able to grow their dividends. So they fit rule number 2 of able to grow their dividends. Heartland Bank pays 7.81%. So Heartland Bank is a New Zealand owned bank. They are growing a lot in their reverse mortgage operations in Australia. And that is also enjoying a lot of tailwinds from the aging population, as these old baby boomers, they want to cash out of their house and they sell some equity in the house by getting a reverse mortgage. They have a high net interest margin as well, about 4.4%, compared to their counterparts, their Aussie competitors like the big four banks. The big four banks have a net interest margin of around 2.5%. So that could mean that they borrow and lend from higher risk clients. But so far they've consistently delivered profit and increasing dividends. So I think this fits into number 1 and number 2 because it already pays a satisfactory dividend, a very nice dividend yield, gross of 7.8%, and they will achieve about low double-digit growth in earnings per share per year. So expect that to be a medium-term hold. Z Energy, they are a fuel operator in New Zealand, vertically integrated from procurement to marketing, so the entire way through. Dividend yield of 9%, so this is very attractive for me. You might say, isn't it going to be a sunset industry when electric vehicles come in? Currently in New Zealand, the EV uptake is quite low. So there's not a lot of electric vehicles on the road. I'm not worried about EV as well because personally I own some Tesla shares in the US. I am hedged against the EV revolution. So, but I think for New Zealand markets, comparatively to other assets, Z offer a very compelling yield. So this fits rule number 1. I don't expect them to grow earnings at a clip because they're a fully matured company. So expect them to pay consistently 9%. Next one is NZX. So this is the stock exchange that you're buying. That makes up 5% of the portfolio, and they have a very nice dividend yield as well, 8.87%. Yeah, there's not much to say. This is basically a company that takes fees from brokers and sells data as well, financial data. They sell a few ETFs as well. They make fees on that. And overall, I do feel like as people get into shares with the Sharesies platform and all that, it'll give NZX more exposure to more small time investors, and I do see some growth there. They have been inefficiently run in the past, so I'm aware of that, and so that's why I've only allocated 5% to the portfolio. But this fits rule number 1 and maybe number 2 if they can grow their earnings. Main Freight, 3% of the portfolio. They have a low dividend payout as well because they are growing quite a bit. They have a fantastic management team. They have been increasing their dividends year on year, so increasing it steadily. I am aware though that the valuations might seem kind of high, but I wanted some exposure to large cap stocks, so I only allocated 3%. The last one here is Precinct Properties. So they have a portfolio of commercial properties. The PwC Tower is one of them, and they have a lot of other towers, buildings in the city centres of Auckland and Wellington. They're basically a REIT, real estate investment trust, and expect to receive REIT returns, I guess, which means usually that they pay good dividend yield, 3.87%, and I expect that to grow steadily in maybe high single-digit growth percentages. So that sums up the portfolio. And my rationale of why I invested in it. So hopefully that was good value, and over time we'll have a look at how the portfolio grows, and I'll be excited to see where this goes. If you have any questions on this, just let me know, hit me up. Until then, take care.